Good morning, everyone. Amber Tatch at Gershman Mortgage, and I am with
David Bell, also at Gershman Mortgage, and we are walking through frequently asked questions from homebuyers. What we got on this one?
So all the time I get this when they're contemplating going back and forth with pulling credit or not. How does applying for a home loan affect your credit score?
Oh my gosh. Yeah, this is the one. Yeah. Even the guy behind the camera right now is smiling because we do hear it. As lenders, we hear it. Oh, I don't want somebody to pull my credit because I don't want it to ding my score. Well, I will tell you as a certified credit counselor, there are five different factors that affect your credit score, which I'll rattle off here in a minute, but I do want to explain the most important piece just for this video in case you guys want to just fast forward through all the other stuff. The last factor is credit inquiries. It's the smallest. It equates to 10% of your total credit score. And that means that on a scale of anywhere from 300 to 850, if you have multiple credit inquiries over the course of, let's say, 2 to 3 different months, like you're talking a bunch of different lenders over the course of time, get delayed and then take a look at lenders again, yeah, you could possibly see a reduction in your credit score by maybe 4 or 5 points based off the number of inquiries. Truth be told, most people when they go to buy a car don't realize how many inquiries they have when they're using the in-house financer at the dealership.
Sure.
So you're going to have a lot more of dings in that particular case. But another piece of the puzzle that people don't realize is when you're applying for a home loan mortgage, the U.S. government wants you to do some due diligence. They want you to look around and compare and contrast and get the best deal for you. So they give you a 30-day window of opportunity to say, hey, go ahead and take a look, shop around, compare and contrast. Problem with the 30 days is if you do that, if you start on day one and you talk to one lender, you wait till the 15th to talk to the second lender, you talk to the third lender on day 30, you're not going to have an apples to apples comparison because the interest rates have changed that much over the course of 30 days. But the key piece here is it's such a small factor. And when we're working with clients, the piece that a lot of people don't realize is as a certified credit counselor, and that's something I hold in very high regard, is I have the ability to take a look at their individual credit and give them tips on how to improve their score. So yes, you had an inquiry. That could affect up to 10% of your score. Most likely it's not going to be a huge amount, but it could affect it, and I want to make sure people know that. But over the course of just that review of that credit report, we're able to pinpoint things that are able to improve that score. And one of the biggest things is 30% of your score is based off your credit card utilization versus the maximum allowable per card. What the hell do you even mean, Dave? That means if you have an individual credit card that has a maximum allowable of, let's say, $1,000, and you exceed 30% of that $1,000 or $300, it's going to affect your credit score by 30%. Now, yes, as an inquiry, you may have affected your score by 10. But if, as a lender, I'm able to pinpoint 2 or 3 different credit cards that you're a little too high on, and then you start to make adjustments and you pay those darn cards down, you'll see a pretty significant change over the course of the next 30 to 60 days on your credit score just because you weren't aware of that secondary factor. And I mentioned earlier that we were going to go through all 5 factors. Let's rattle off those factors right now just so everybody knows what they are. 35% of your credit, biggest factor is making your payments on time. So if you're not making your payments on time, why are you even worried about inquiries? Because the fact of the matter, you're dinging your credit pretty massively just by going late. The next one is what I just mentioned. 30% of your credit is based off credit card utilization versus your max allowable. Stay below 30% on the individual credit cards. And that's huge. A lot of people don't realize that when it comes to credit card utilization. 15% of your credit, that is credit longevity. And that is kind of the Super Mario mushroom where it's going to superpower you if you're making your payments on time and you're keeping those cards below that 30% threshold. The longer that you do it, the stronger it gets. Conversely, if you just had a brand new account open, that 15% is going to work against you. So you may have a slightly lower credit score in those particular situations because 15% of your credit is saying, hey, this account hasn't been open very long. We don't know if they're going to make their payments on time. We don't know if they're going to keep their credit card balances low. So it's working for you or it's working against you depending on your utilization. The last 2, I've already mentioned inquiry, they're 10%, but also credit mixture. So if you have a mortgage, if you have a couple student loans, if you have a car payment and maybe 1 or 2 credit cards, that's a decent mix. The guy who comes in that's never had a mortgage but's had 20 different credit cards, all right, your mix is going to be off and that's going to affect your score a little bit. Conversely, the guy who doesn't use credit cards, but they have mortgages, and let's say they're an investor, they could see their score a little bit lower because they're not utilizing the credit utilization factor. So mixture is 10% of your score, but those are the 5, math is hard. Those are the 5 factors that affect your credit score. Nothing else, those are it.